All right, today we are diving into a pretty wild story from the world of finance. A lender just dropped its Q4 2025 earnings report. And honestly, the numbers are so good, we just have to break it down. So let's get into it.
Okay, let's just start with a headline number, the one that's making everyone's jaw drop. In the fourth quarter, this company's pre-tax profits absolutely exploded. And I don't mean a little bump. We're talking a 4 times increase compared to last year. That's right, a 400% surge. Just incredible. So that leads to the obvious question, right? How on earth did they pull this off? I mean, in a market that's been pretty tough for a lot of folks, how does one lender not just do okay, but absolutely crush it like this? Well, let's dig in and see what's going on. So the whole story really starts with their bread and butter, their core business, lending. This wasn't some kind of fluke or a one-off deal. Nope. The engine behind this amazing growth was a massive, and I mean massive, surge in the number of loans they were creating. Get this. In just the last 3 months of the year, they churned out $2.6 billion in new loans. That is a 40% jump from the same period last year. So you gotta wonder, where is all this business coming from?
Well, what's really cool here is that the demand is coming from both sides. On one hand, you've got a ton of borrowers who clearly want their loan products, but on the other hand, you have investors who are lining up to buy those loans from the company. And that's because the quality of these loans is just top-notch. So good, in fact, that the company doesn't even need to offer extra guarantees to protect the investors. That speaks volumes.
Okay, so they're making a whole lot of really good loans. Great, but how does that turn into actual profit? Let's take a look at their financial blueprint, how they turn all that activity into cold, hard cash.
They've basically got two main ways of making money. First, there's the immediate cash they make when they sell some of their loans to those eager investors. That's called fee income. And then second, there's the money they earn over time by holding on to other loans and just collecting the interest payments. That's interest income. It's a really powerful 1-2 punch.
And here's where you can really see that strategy paying off. Both of these income streams are just on fire. In Q4, that fee income shot up 38% to $103 million. And their interest income? Well, that hit a new record high of $163 million, which is up 14%. They aren't just growing in one area, they're firing on all cylinders.
But hang on. Is this just a case of a company getting bigger, or are they actually getting better and more profitable? Are they growing smart? To figure that out, let's pop the hood and check the health of their financial engine. First up, let's talk about a term you hear a lot, net interest margin, or NIM for short. It sounds technical, but it's super simple. Think of it as the profit margin on the money they lend out. It's the difference between the interest they earn from borrowers and the interest they have to pay out. And their NIM is a really strong 6.0%. Now, that number by itself might not sound crazy, but what's important is that it's a huge jump, over half a percentage point from last year. It means their main business is getting more and more profitable. All right, next up is a metric that investors absolutely love to see, ROCE. It's a bit of a mouthful, but all it really tells you is this. How good is the company at taking its own capital, its own money, and turning it into more money for shareholders? The higher this number, the better. And yeah, they are absolutely crushing it here. Their ROCE for the quarter was a massive 11.9%. And to put that into perspective, that was even higher than their own forecasts. So they're not just meeting expectations, they're blowing right past them. So what's the secret sauce behind all of this success? It really all comes back to the quality of their assets, the loans themselves. People are paying their bills on time. Delinquency and loss rates are way lower than their competitors. They are truly at the top of their game when it comes to managing risk. So that's the incredible story of Q4. But what about what's next? Well, the company also laid out its game plan for 2026, and it includes a pretty big shift in how they do their accounting. Let's see what that's all about.
Okay, we're gonna get just a little bit technical for a second, but stick with me because this is actually a really big deal. The company is adopting something new called the fair value option, or FVO. So, what in the world is that? Here's the simple breakdown. The old way of doing things meant that every time they issued a loan, they had to immediately put aside a big pile of cash just in case that loan went bad someday. It was like a mandatory rainy day fund. But this new FBO model is smarter. It lets them match up their income with expected losses over time. The bottom line? It's way more efficient. It frees up a ton of capital they can use to grow the business even more.
And you can really see their confidence in this new system when you look at their forecast for 2026. They're basically planning for another year of huge growth in loans, and they expect a really nice jump in their earnings per share, too. They are not sitting back and relaxing, they are stepping on the gas. So when you put it all together, what have you got? You have a company that is just humming, coming off a record-breaking quarter. They've got incredible momentum, and now they have this new, more efficient playbook. So I guess the big question we're left with is, are they set up for yet another record year? It's definitely going to be fascinating to watch.